All right, so welcome. Today I'm going to go through this investees raising funds. So we're going to go over what is the biggest challenges, what regulations exist, and what is right for you, and what are the main instruments in raising funds. So let's go straight into the challenges. So one of the biggest challenges is really you need to kind of think about what your business is and how it adds value. So this is something that sounds simple, but is actually complex. It's all about getting elevator pitch and really understanding what's adding value to the investor and how it's adding value to the investor. The second biggest challenge is the accredited investors only factor in 3% of the population, and that's from qz.com. That's a fact from there. I've seen numbers as high as 8%, and I've seen numbers really sitting at the 1%, maybe 2% of the population. Now, even if you factor in the more optimistic 8%, saying that the people that qualify to be accredited investors, then you have the question of how many of those people are actually at a point where they can afford to be an accredited investor, how much have the liquidity. So this number of the population is going to be small. And that's something that you need to keep thinking about when you're deciding your regulation, how much you're going to raise, and where you're going to find these people. Regulations in the US are complex, so this is something that is hard. It's tricky in the market because the way the regulations are set out, the gap between non-accredited investors and their choice of what they can invest in versus the accredited investor is massive. There's really a large gap in the market, and advertising and selling to non-accredited investors generally involve more cost or limit in how much you can raise. So it's complex and it's messy, and the bridge between the two, as I said, it's just a very big gap. So what choices do you have? So let's talk about if you're raising around $1 million, slightly higher, slightly lower. Your idea is marketable and disruptive, or it's niche. So what I mean by that is if your idea is, you're coming to the market and you believe that this is going to be the next big thing and you're doing something very unique in the market that's going to make this grow. Or if it's niche, such as energy, green energy, water ideas, there are very specific niche portals for raising funds in these kind of markets. So if you kind of generally fit into these two categories, then generally the crowdfunding option is going to be good for you. How this works is that the crowdfunding websites, you'll submit your ideas. Some will require you to bring on investors in the beginning. You'll need to pass regulation CF, but generally the portals will do that for you. The portals themselves are regulated and registered. So you'll go with them with your funding project. They will start raising capital under regulation CF. Now, if they hit the $1 million mark, because the limit is 1.07 million, they will do a little bit of trickery there. They're going to split out your accredited and not accredited investors into two pools, and your accredited investors, they will go under regulation 506C, which is a different type of regulation that allows to go over the $1 million, the $1.07 million mark, and the other unaccredited investors will stay in the $1 million pool. What if you're looking for really a larger amount over the $1 million? So this is an option. If you have a lot of associates that you're going to invest in, like it's going to be a fairly private raise, you can go under regulation D506B. You could call this the family and friends package. So you can get 35 non-accredited investor. The ruling here is they have to understand sophisticated investors, so they've got to have some kind of knowledge, and you as the company raising need to make sure that you've proven that they have the knowledge of investing to be able to invest, and you have unlimited accredited investors, and you're not allowed to do any solicitation, basically no marketing allowed. So really it's a family and friends kind of network with people that have knowledge. The next one is when you want over the $1 million and you want to do marketing. So this is 506C. You don't have any limit here. You can raise as much as you want. Once you've declared how much you're going to raise, you can market to your customers, but there is caveats here. You can either use tombstone communication or non-terms communication. So tombstone communication is where you're just sending the facts out. you can send out information regarding a 7% return. It's going to be a 5-year contract, all the facts, boom, 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 boom. But you're not allowed to put anything in a salesy tone or say this is going to be a great opportunity or these are guaranteed returns or anything that's seen as salesy. And there's regulations. You can download the PDFs and check them out. The non-terms communication is the exact opposite. So you cannot mention anything about the financials. You cannot add anything about the percent returns, anything about the deal you cannot mention. So when you're doing 506c, when you do a single part of advertisement, it either has to be the tombstone or the non-tombstone communication for you allowed to promote this deal. Some people combine this in the sense that you can have both, but just not simultaneous, and it's best that you go through and learn this if you're planning to market this. But it does mean there's ways to open the doors to investors and direct market to them in the way that you want to market to them. 504 is a very interesting ruling. It's up to 5 million. It can be accredited or not accredited, but it's not controlled by the federal government. So what that means, it's not something that's, if you're going to raise funds through multiple states, you need to comply with each state's specific rule. And generally people are not using this. I haven't seen it used because of the complexity involved in this process and making sure you do keep in contact with those regulations state by state. Now, this is the Regulation A+, also called a mini IPO. In here, you can raise up to 50 million. There's tier 1 and tier 2. So tier 2, you've got non-accredited and accredited investors, but this is a very interesting option, but one of the problems is that it involves a lot more filings with the SEC, a lot of audits, and there's a fairly high cost to using Regulation A+. But definitely, if you're looking for the larger amounts and you do want to attract non-accredited and accredited investors, then this is a very good challenge. But really, if you need to be raising above 5 million to make it worthwhile, so the cost of acquisition is not going to be so high to burn into this capital. So Regulation S is safe harbor. Now, safe harbor is when you're going to sell to foreigners, people outside of the USA, and you really have to make an effort to not sell to people in the USA under Regulation S. So when you promote, you're not allowed to take people from US IPs, for example. So if you created a specific offering for these people, you need to make your effort to ensure that it's not come from a US IP. You can't target things like military offshore or anything like that, or other kind of US people that might be overseas specifically. And when you do sell it, you need to make an effort to make sure that they're not US citizens or Americans. On the other side is that there's no limit about the investors, which is a great thing. You can just target whoever you want, but also this regulation is suddenly regulated by the people and the country that you're targeting. So it gets a little bit more complex in terms of promoting and advertising to those people. And when you're selling, you must follow their rules. Well, you need to check their rules and follow the rules because it's going to be different by every single country. And when you do sell those securities, it's under safe harbor, so you must follow safe harbor rules. And in general, those safe harbor rules means that once that security is sent offshore, it can never come back to the US again. So that's something you need to consider with your instrument. If you're going to sell later, your company, and how you've kind of set that up, you need to factor that in. If you decide to go with safe harbor, how that's going to impact your future business. A little caveat here that I want to talk about is SPV. An SPV is a special purpose vehicle, used quite common in the raising funds scenario. And how they're generally used, it's about taking a lot of investors, being able to raise funds from a lot of investors, The SPV is the group, to be able to group them together. So all these single investors are registered with this SPV company, and that special purpose vehicle company is then, once it's invested in the primary company, it comes out as a single record. This is done so you don't have a whole long list of investors, can control their influence on the company and how they operate. So this is something, when you're thinking about raising funds, that is something that you might need to consider in the process. There's a lot of securities that you can sell, and I'm just going to go through some very common ones here. One is the SAFE agreement, simple agreement for future equity. I've got this from Wikipedia. It's an agreement between an investor and the company that provides the right to invest for future equity. Basically, it's you're holding on to this paper for when this company IPOs, or whatever that trigger event is that they've declared in this simple agreement of future equity. Then this can be executed, and the idea is that this future equity position makes it a little bit simpler in terms of especially pre-seed or seed companies whose evaluations are questionable or are very hard to evaluate because they are new technology. It's hard to benchmark against a competitor or any other kind of concept. That this SAFE agreement kind of gives protection for the investor to some degree in terms of how the actual value of what that security is. But as a common saying goes, safe is not safe. Every investment has its risk, and if the company never IPOs or never develops, then that agreement is potentially not worth anything at all. Another type of equity investment are the subscriptions. It's the name that they use in real estate quite often. When you get a subscription into a real estate property, you're going to receive your cash on cash, which means quite not all the time, but when a property is structured and they're planning to either refurbish it or acquire it, rent it out for 5 years and then sell it, this is an example, then that subscription deal would generally allow you to get a cash on cash, which is any rent paid, you're going to make a percentage of that rent, depending on the agreement. And after the 5 years and they sell the property again, then you're going to make a certain dividend from that property. Each one of these can be quite different when you actually get into the terms of it. Promissory note, this generally will act as a type of loan. It's not technically a loan, but it's pretty much like an IOU, and these are generally structured in a way that are paying some kind of regular percent interest. So they'll be paying you, for example, like 7% per year, paid quarterly or monthly or whatever the structure is. This is used commonly on investment on loan sites that you'll see, and a lot of other websites. Bonds and debt, this is interesting, and I've just noticed, I guess on my own personal research, that this is becoming more common, where companies are offering a bond maybe over X amount of years to do things like refurbishment, growth, but generally the ones that I've been seeing are structured that they have company history, they've got proven revenue, and they're just looking for this extra capital to grow to the next stage. So some examples I've seen is an ice cream shop looking to create new flavors and getting a small bond, or a cookie store that wants to relocate to a bigger office, so they need to get those initial capitals to afford to do that moving and things like that. So that's a couple of example. And the last one, which I see a lot less, is direct equity, which is just selling equity into the company. Now this is obviously in the share market, it's completely different, but in terms of the regulations we talked about here, 506C, A+, crowdfunding, then selling direct equity can exist, but it's definitely less common that I've seen. And that's really it. So hopefully that gives you a quick overview of the different types of regulations and the types of security and where they kind of fit, and some of the major problems which are facing companies today.